I'd like to invite two very esteemed founders, Ben, founder of Clean Skin Club, and Mark, founder of SURI. Thank you guys for joining. So maybe quickly for the audience, you can do a quick intros about yourselves and the companies.
Sure, I'll start. My name is Ben David. I'm the co-founder and CEO of Clean Skin Club. Wasn't really into e-commerce all the way up to 2018 is where I really started to get involved with it. Before I was just doing sales and I was selling pretty expensive products on retail, and I thought it would be cool to sell cheaper products online to more people, and it was very interesting to me. So we just went into it. My partner and I invested everything that we had in a brand that we really believe in, and we saw a gap in the skincare industry with skincare hygiene that no other brands were actually attacking, and we went all in. It was an absolute failure in the first 6 months. We suffered anxiety, and it was just horrible, losing hundreds of thousands of dollars. But it made us really strong. So we bounced back and we were able to scale our brand, launching in 2019 from doing 500,000 in year one to this year when we're gonna come just $2 to $3 million shy from 50 million, and ranking ourselves as one of the top 10 beauty products on Amazon. So really proud of that and excited to share my experience.
Wow, that was amazing. So my name's Mark Rushmore. As you can tell from my accent, I'm from London. I just want to say thank you so much for inviting me to LA at this time of year. It was raining, cold. This is absolutely glorious. I'm going to try and work out a way to move here. But I'm the co-founder of SURI. SURI is short for Sustainable Rituals. Actually, to help me explain it, can you put your hand up if you brush your teeth? And keep it right up. And then keep it right up if you use an electric brush. Okay, great. And if you use the app on that electric brush every day, can you keep your hand up? Oh, so that's interesting. No one's using the apps. And what we found is two things. One, every single year, over 4 billion toothbrushes are thrown away and end up in landfill in the ocean. Virtually every single toothbrush you've ever used since you were a child probably still exists and will do for a long time. And we think it doesn't have to be like that. So we've made the world's most sustainable electric toothbrush, but we've also taken consumer insights. So we found people aren't really using the apps. They'd rather have a long-lasting battery, or people want a brush that they can travel with. So we have a UV light in our case, which kills 99.9% of bacteria. And we're a relatively new brand. We only started shipping in May last year, but we've just seen really phenomenal growth in that time. And hopefully one day we can be top 10 Amazon with 50 million in sales.
Congrats. So Ben, I will start with you because, we in Uncapped have seen tens of thousands of companies, but, from 0 to 50 million in what, 3 years to 3 years?
We're gonna finish year 5 now.
Okay, year 5. And bootstrapped, right?
Yes, so we own 100% of our company.
This is insane numbers. I'd love to learn more about how you started the company in terms of funding and, having a capital to have a first production and products and marketing.
So we were lucky enough to be in the retail business, my co-founder and I, and we had some money saved up. What people usually do in the retail business when they make some profit from it is either open more retail locations or start to buy real estate. And when we talked about it, we always talked about, okay, we'll do that, and then what? And then what? We're in our mid to late 20s. This is our opportunity to try and really conquer the world. What are we going to do? Should we go all in? Well, if we're going to go all in, this is the time to do it, right? Because if we crash, we can still bounce back, go back, open more retails. So we just decided to invest everything that we had. I think between the both of us, we probably had about $750,000 saved, and we just went all in. In the beginning, we just went with a big marketing company, and we thought, this is how it works. They work with big brands. It's going to be amazing. We probably lost like $250,000 with that decision. So if it's video production of $30,000, $40,000 a video that completely failed after 2 weeks, or other products that we developed that we just threw to the garbage because nobody wanted to buy them. So it was a lot of trial and error until eventually we saw that what differentiates the brands and the founders that succeed from the ones that fail is the way they react to when things go horribly wrong. Because it's gonna go horribly wrong to everyone at some point. It's not gonna be sunshine and rainbows, and you're gonna crash and fall. We make dozens of mistakes every single day, and we just learn to bounce back as hard as possible.
But did you find were you like profitable from the beginning?
Oh no. Any of you that understand the basics of ROI, the basic thing is let's put money in and let's try to get more money out. That's not how it works at all. And it differentiates between brands that will have retention. So will customers that like the stuff that we sell to them will come to buy back independently because they like the experience or not. In the beginning, we would spend $10,000 on marketing in a month and we would get back $1,500 in sales. So we can look at it at a ROAS of 0.15. And in the beginning, the marketing company told me, well, that's how you start, and these are great numbers. Obviously, that was a bunch of crap. So we went from one marketing company to the other marketing company, and we saw that we're just not being profitable. We're just losing money. And then I started to really go deep into the numbers. The most important report would be new versus returning customers. And that's something that I think, as much as people talk about, is extremely underrated in our industry, especially if you have a product that you want them to come and buy it more than once, right? So what happened is we started to see that returning number going up a little bit, and we thought, okay, so we're pouring a lot of money in, but we're starting to see the organic retention, so people are starting to come back. And we started to figure out this formula of what will happen if we invest more. It took a while because we had to learn to control both micro and macro. So we had to see which ad works the best and which is the product that they come back for and why are they coming back and when are they coming back. So when we see this loss, it's 0.15 or it was 1.5 when we acquire them. But what happens after 6 months? What happens after 10 months? What are the averages? How many people like it? How many people come back? So we were not profiting at all. I can tell you that till today, we have never in any months made profit on acquiring new customers. We have never acquired customers at a profit. If we would try to do that, when we tried to do that, we saw that our growth was very, very, very slow. And the reason why a lot of brands do that is because they don't understand the depth of their numbers, the ins and outs. The more we focused on the micro and understanding when the consumer will come back, why will they come back, we were able to spend more losing on the first acquisition, but understanding when the profit will come. And that's also what led us to get funding rather than trying to sell some of our business. Because the only difference between the two is how well you know your numbers and how much you listen to the stories that the number tell you, both on the micro level and on the macro level.
So how did you manage this? Because this is the story we see all the time, e-commerce brands, they need to spend money to acquire the customers, but the payback period might be, in 2, 3, 4, 5, 6 months, sometimes more, 10, 11. And then the faster you want to grow, the bigger cash flow you dig. And then you don't want to raise the money because you don't want to dilute yourselves. How did you solve it?
So that's where it comes to gamifying our business. We really looked at it as a game and as risk management that we as founders take. You choose how much you want to gamble. It's very similar to going to a casino, but you're not going to go to the slot machines. It's more like poker because there is a luck aspect, but you want to minimize that as much as possible, right? That's how poker works. So you will decide when you get the funding, when you decide to invest, if you want to invest in riskier ventures or less riskier ventures. So when you want to invest in data that you're already familiar with, like acquiring customers and seeing when they're coming back, that's probably a lower risk, because at the end of the day, when you're in scale and you get those numbers stay the same. If you want to go out of it and try to do a new product, which is highly risky, or a new creative, a big production that you don't know how it's going to work, like the lecture before us, they were speaking about creatives, and one of them is a huge production, one of them is a UGC. They're 100% right. You don't know which one is going to work. So, like I said before, we had ads that we spent tens of thousands of dollars on that did nothing, and we had ads that customers sent us from their phone, taking a little selfie. They gave it to us for free, and those ads made for us hundreds of thousands of dollars. So when we think about funding, we think about trying to lower our risk as much as possible with some of it, and then some of it, go crazy. How will you know what percentage you want to go high risk and what percentage you want to go low risk? That's up to you, and that depends also on you individually. Do you want to play a riskier game? You're going to get a bigger reward if you win, and you're going to fail more if you don't. You want to play it safer? That's up to you. So I think it's very individual for each brand. For us, I can say that we were always high risk, high reward, go for it all, see what happens, and if it crashes and fall, we were okay with starting again from zero.
It seems like it's paying off. Mark, you're taking a bit different route, right? Because you took VC funding from a very reputable VC fund in London. You also took some debt. So what was your funding story, and at what point did you decide to switch from, equity to debt, and maybe you want to come back to equity at some point?
Can I just start off? I just think this guy's got balls of steel to sit beside the guy who's lending him money, being like, I'm going to go broke if it doesn't work. I'm just going to throw the cash down. And this is a guy like lending him millions of pounds, so respect. Yeah,
I will talk to my team afterwards,
Unlike Ben, I was approximately $750,000 short of any sort of money of my own to start the business. And so I had to go to someone and persuade them to give me some of their cash. And again, like, we have totally different business models. I would love to say that we bootstrap, but we weren't in the position to do that. And also a very different thing is we're first order profitable. And we have a ROAS of like 2.5 to 3. And so what we do is we like really want to like have a growth model that's sort of like a sustainable, repeatable process. But yeah, no, taking venture funding obviously is very different. And we're really lucky as well. We've had incredible traction. I'm sure all of you have had that sort of experience where, when we launched, we sold out really quickly, which we were like really celebrating. Then we're like, oh no, hold on a second, we actually need to get more stock. And it happened a couple of times until we could really sort of do better forecasting. But every month we're just sort of seeing unparalleled growth. And when you look at your options, actually, can I just see how many people are venture backed here or have some sort of investment for equity? So yeah, not so many. But you've got to find that balance. We don't want to just keep giving away the company until you're, making money for someone else. And so we're really lucky to work with partners like Uncapped. Actually, we've had a really great experience. The platforms have been really quick, the team really responsive, and understand us as entrepreneurs and what our needs are. So yeah, no, it's definitely a journey. Yeah.
So why you both are, you're a customer of ours. You work with similar funders. Why you decided to go this route rather than maybe bank financing, asset-backed lending? There are so many other options.
We tried. We went to our bank. We went to, I believe it was Wells Fargo, and we had a lot of money in the bank. We had hundreds of thousands of dollars in the bank, and when my partner reached out to them, they were able to give us a $10,000 line of credit. And we were, what? We have hundreds of thousands of dollars with you. You see the money going in. What is this? The response was basically, we don't know what's going to happen. E-commerce, it's not a really safe space. And we were shocked at what happened. And then we started to go and reach out to companies that are e-commerce focused. They know how to connect to your platform, see the numbers, and kind of speak in your own language of, oh, you have people coming in and getting that reoccurring revenue, the returning customers, what are the ratio in between? Finally, somebody speaking our language. And we did find some companies that let us do it. What I can say really positively about Uncapped is that it's probably the best funder that we found that speaks our language and understands us. My partner, which is our CFO, he always says to me, I love these guys because they speak to me like they're my friends. Like, I can talk to them freely. They don't look at me as just a number. They see my vision. They go into the numbers just like I go into the numbers. So when I talk about the bright future, they see it. Because when we were doing a lower revenue a year or 2 years in the past, and we went to lenders and they say, yeah, but we don't really know if you're going to continue in this trajectory, we were like, okay. And then we did. And then they come back to us, hey, now do you want to take money? We're like, no, you didn't believe in us. You didn't believe a word that we said. We had to convince you, and you looked at us as numbers. That's why we really like Uncapped.
Enough with the advertising, this is okay. Like, I'm curious, like you, Mark, like, have you tried, maybe PO financing or maybe factoring or anything else in your business that could have been helpful?
Yeah, absolutely. So I'm just really focused on profit. Like that's really important for us. And so I'm just constantly, as your poor team know, like negotiating and kind of playing people off each other and trying to get more and more value. And so PO financing, you pay a lower rate than the kind of trade financing that you offer. There's venture debt, obviously, which is good for certain times and so on. And so with our head of finance, we're really looking to find what's like the optimum blend, essentially, from a cost effectiveness perspective.
And speaking about optimal blend, I'm always very curious how founders like you think about optimal level of debt. Do you think there is like optimal level of debt you should have in the business? Like you, Ben, told me at some point that you think you should lever as much as possible because you're brave. Do you still think so? Maybe Mark, what's your take on this as well?
Yeah, so for me, like debt is just the opportunity for like sensible growth. Like we don't want to laden ourselves with like overbearing debt. We've seen enough crises over the last few years to see what happens. When the winds change and suddenly you've got too much debt. However, ultimately, like people who use it strategically, people who use it, in a sensible way to sustain, better growth, I think, are the ones who will grow more quickly. And so that's how we look at it.
Did your VC, I'm sorry, I will come back to you, Ben. Did your VC influence in any way your decision about, how much that debt to have, what's the optimal level, take more, take less, take longer duration, shorter?
Totally. Actually, we have two different VCs, probably with two different views. One of our VCs, he actually sold his own company for £500 million to Coca-Cola. And his view is like, you want to hold on to that equity, Mark. Each 1% when you come to an exit is going to be life-changing for your family and for generations. I'm not sure if that's true when they sell for £1 million, but no. He's really strong on like holding the equity, and therefore, inventory financing, it's such a dumb thing to take equity for, to have to trade your equity, which is your most valuable asset. And so he's, all about that. Whereas, there's some other VCs who just want to take as much equity as possible. So they're like, yeah, take our money instead. I think it's just understanding what everyone's game is. And our game is, optimizing for our exit, optimizing for growth, and optimizing for like, a solid business plan based on profitability.
Ben, what's your take?
So I think time has a big part of this equation. Where do you think the business can go? Where do you want to take it is great. But when do you want to do these things? That's a big question when it comes to financing. Can my business get to 9 figures? Do I want to take it to 9 figures? Do I think it's possible? And if so, when? Do I want to do that in 15 years from now? Okay, right now I'm 32, so 15 years, 47. And these are the things that we think about when we're trying to get funding, when we want to know how much to fund, what is the optimal rate. You have to put time in the equation. So I feel like a lot of businesses do it slowly because that's what they want to do. Maybe they have more businesses on the side. Maybe they want to play it more safe. And yeah, I would like to get to that number in 10 years from now, and I feel comfortable with it. So I think your personal goals of the founders are also very much connected. There's a difference between if you're starting a business when you're 22, 23, or if you're 40, 45. It really depends on the time and when do you want to get to your goals. And I think that will depend if you want to take on more debt and play a riskier route, rather than taking lower debt and take a less riskier route.
Maybe we have a few minutes left. Any questions from the audience? Comments? Okay, cool. In the meantime, then, if you have any, please let us know. Speaking up about levering the company, debt holders, debt providers have even more impact on the company than equity providers. Like, people who you have debt with can literally probably much more control the company if something goes bad, take over, because, debt is much more higher in the capital stack than equity. How are you thinking about this, if at all, when picking debt provider or picking what kind of debt to take?
I think flexibility would be the key word if you're in a dynamic business that's growing. You want to have the ability to take debt when you need it and how much you need it. So sometimes you need to commit long-term to an amount of money that you don't know if you need, because you don't know how your plays are going to work out. You don't know if what you're investing the funds in, whether it's marketing, product development, you don't know how that's going to work. So you want to be prepared for the worst case scenario, but plan for the best case scenario, right? So the cool thing about getting flexible funding, like a line of credit, for example, is that you can choose to take a certain amount of debt, and you know that if it goes well and you need more, you can do that instantly, rather than committing to a number for a long period of time that you're paying it based on an assumption that you had 2 months ago, but 6 months ago, you don't know what the hell is going to happen, especially after what we saw in 2020, that everything goes in the blender and starts again and again. So I think flexibility would be the key indicator of how to choose the right funder.
I think from our side, there's types of debt where I can't remember the right term. You'll know the right term. It's like secured, and it can be like secured against like your life and like your
child
and like all that kind of stuff. We tend to try and stick away from that kind of debt, just because it seems like an unnecessary risk. And if you're taking that kind of debt, your business might not be in that great a place anyway. And so we prefer the ones which like have that flexibility but without securitization.
Got it. Cool. Any final questions from the audience in the meantime? No, I think. One there.
When you're starting your business, how do you think about like blend of like direct to consumer versus marketplace, and like what is the right balance of feeding the machine of marketplace versus investing in yourself?
Okay, that's a massive question. So obviously, when we say marketplaces, let's call the beast by its name. We're talking about Amazon, right? So I can tell from my personal experience, we were running directly D2C. D2C was doing 90%, and Amazon was doing 10%. And then slowly you see the beast taking over, and customers want to get that one-day shipping. They want to get that same-day shipping. And you notice that you cannot provide that experience while doing D2C. So for years, for the first 3 years, we were probably fighting Amazon, going just D2C, going aggressively, and putting Amazon as like, it's there. If people want to buy it, they can buy it. We're not going to put a lot of money and investment into Amazon because the profits are less. And when you want to sell the company or exit the company, a lot of those companies that want to buy you, they look at Amazon as a negative part because you're not in control. It's not your market, the data, whatever. And we've seen a shift because us, as well as the companies that will eventually you want them to buy you, they look at Amazon as, this is here, this is going to stay. And 57% of all e-commerce in the United States is Amazon. Not a lot of people know that. 91% of consumers will price check on Amazon with every single purchase. 91%. When we saw those numbers and we saw that reflected into our business about sometimes last year, we have decided to stop fighting it and seeing what happens when we push a lot of money into Amazon. That was one of the bigger decisions we had to take, and the results were unbelievable for us. That's what led us to our growth. I'll give you context. Last year we finished with $15.6 million in sales, and we were going to push to 25, 26. After we did the Amazon shift and we saw that we're acquiring customers on Amazon for about $13, $14, when on D2C we're acquiring them for $50, because how easy it is for a consumer to buy something on Amazon. The credit card information is there, even if they never shopped our brand before, it gets there tomorrow. They know 100% if they don't like it, they get it back. And that's what brought us to do the higher number this year because of the growth on Amazon. So to your question, to know the ratio between how much to invest in let's call it by its name, Amazon or your website, it depends a lot on your unit economics. So is Amazon eating up most of your profit, or can you afford to do both at the same time? What I would recommend to do is, and what I would do if I would go back a few years, is start aggressively on both directions and seeing what happens. Because a lot of the times, listening to the journey of the customer with numbers is something that not a lot of people do. But once you do it, for example, I'll give you guys a little Amazon hack. There are 6 states in the United States, Florida, Illinois, and it's 4 other ones, that Amazon has a report called the fulfillment report. Typically, when you're on Amazon Prime, they don't give you the information of the customers. That's not in their policies, unless those customers are in those states. It's a little trick, something with taxes. And if you go to the fulfillment report, you just download it, you get the customer name, last name, address. So you can compare it to your Shopify store. And once you take a segment of those 6 states and compare it to your store, you can get some unbelievable data. Like, for example, we noticed that 27% of people that abandon checkout on our website appear as Amazon shoppers after, right? So when you invest in your D2C, a lot of them will go to Amazon at a lot of different stages. They can go right after they saw the ad, they can go see your website, add to cart, say, oh, before I check out, let me just check it out on Amazon. They can go and buy it on your website for the first time, but when they want to buy it again, just like 91% of consumers will go to check it out on Amazon. So it's basically listening, like I said in the beginning, to the micro and the macro. This is micro, like zip codes of customers, trying to compare to both. And you will see that a lot of the times when you put money into D2C, it feeds Amazon. When you put money into Amazon, it feeds D2C. For us, 85% of transitions are from people that starting on the website and then going to Amazon, and 50% going for Amazon, starting from Amazon, going to the website. It's different from every business, but to summarize, aggressive on both, listen to the numbers on the macro, really, really listen to the micro, and try to find more hacks like the one I just gave you with the 6 states. It was huge for our business.
Yeah. Whoa. Yeah, I was going to have a different answer, but if you grew from 15 to 50 million by going to Amazon, that's our new strategy moving forwards. It seems to work for him. If you could lend me some money, Piotr, that'd be great. Yeah. Throw that on Amazon PPC,
Let's
see what happens.
Tomorrow.
I'm going to call you and see if you give me some tips. But broadly speaking, we launched D2C to build that rapport, that relationship with customers, to explain what we're doing, which is something totally new and different. And from a pure commerce perspective, yes, Amazon, you can slam through those sales. But for us, we're on like a slightly different mission to redefine sustainability in oral care and to sort of transition what people think an electric toothbrush can be and how it can play a role in their lives. But yeah, we'll be doing more on Amazon. I'm looking at you there, Ross, who will manage that. So thank you.
Thank you so much, guys. It was a pleasure.
Thank you.